Good morning and welcome back to Almus Market Mornings. It's good to be back after a break and observe the cross currents that has been challenging investors. The AI boom that has continued to dominate headlines, but it is also pressurizing software valuations as frontier models make no-code solutions more viable. That shift has unsettled sentiment and led to a broader software sell-off as recently as last night. On the monetary policy front, the Reserve Bank of Australia's 25 basis point hike yesterday suggests that the easing cycle may be near its end for major central banks. That's what we have been observing. And back home, the trade deal announcement has lifted sentiments despite limited details, and this has supported the rupee and the equities. Good morning, JK. What do you think markets are telling us now? I mean, gold has rebounded after a sharp fall. The rupee strength, it like always remains vulnerable to dollar's demand. At current levels, what should investors be watching?
Good morning, Swaraj. Good to have you back. So 2026 is almost every day we had some new themes and new uh, influences emerging in the markets. It's all started with geopolitics and then shifted to commodities, parabolic rally and then meltdown in the commodities. And of course, the one good thing for India was the trade deal. Um, budget raised some questions in India, but then, the trade deal has actually overshadowed the impact of the budget. And the geopolitics has been ongoing. And yesterday also we had reports that US forces have shot down a drone from Iran as it stayed near their Air Force. So uh, I think yesterday's move in the software sector in US, the tech shares getting sold off is another, theme that has now started to impact the markets. Now, there seems to be kind of, structural shift in how the markets are pricing the software business model in the light of AI influence. And AI, some people see it now as a disruptor and not as a tailwind. It triggers a fear that many software companies cannot maintain their current pricing power or the customers in view of the capabilities that AI is bringing in. So AI is now having its collateral effect as well. So that's the thing. And India also, of course, has been in the receiving end as far as this development is concerned, because we had most of our ADRs in the US market lose between 5 and 10%, and that could have impact on the domestic stock index as well. Uh, yeah, again, going back to the geopolitics, I think gold received very good support. In fact, gold's meltdown was a bit surprising. Silver, of course, had its own special factors because the speculative element in silver buying was much more. And as the exchanges increased the margins, the forced liquidation did take it to 35% lower from the peak prices. But gold always has large long-term investor support as well as the central banks, and that is why gold has swiftly come back up above 5,000 today, and low seen was 4,400. That too in a very thin market. So gold is definitely hog the limelight now compared to silver, but not to take away the fundamentals that are supporting silver, but because of the positioning, perhaps silver will take some time to catch up with gold. But all said, I think fundamentals will keep the precious metals in demand. Uh, of course, we also had the partial shutdown of the U.S. government taken off after the House approved bipartisan deal for the remaining spending bills. But despite that, I understand that the jobs market report, that is the Bureau of Labor Statistics report on monthly employment, is unlikely to be released on this Friday. And we didn't have even the JOLTS data was not published yesterday. That gives some sort of indication on how the job market is, trending of late. Then, of course, in a lot of questions on India trade deal. One thing that has emerged is that it is a framework of the deal. No fine final deal has been signed, and it is going to happen in the days to come. Market will look at the fine prints of the deal eventually, and for some doubts that came up, it appears that the penal tariff is also removed. Therefore, the total tariff on India will only be 18%. But of course, in the final deal, people will look at what products get what kind of tariff. And of course, there are some products which still attract higher tariff that is applicable to all countries. And then, even Indian officials have clarified that on sensitive areas such as agriculture and genetically modified crops, the safeguards are in place, and all uh, sensitivities from the point of view of Indian interests have been taken care of. While Trump also mentioned about 500 billion of imports by India, officials in India also clarified it's over a period of 5 years and includes a wide range of merchandise imports. All said and done, I think the deal is, of course, a big big relief that we have had. The tariffs being reduced substantially from 50 to 18. It's a big boost to the exports in some of the key sectors like textiles and jewelry. But then, is this the turning point for the rupee? Is the question that everyone is having. My own view is that it is not. It is a big relief rally, no doubt, because market had one of the big factors driving the dollar rupee higher had been the trade tariffs at 50%. That concern has gone away. But what we need to see is that the mismatch between demand and supply that has been plaguing the Indian rupee for quite some time now, because of the large outflows from FIS, lack of inflows on FDIs, and importer hedging, being substantial, whereas exporters have taken a back seat. All these things have been supporting the USD INR. Keeping these in mind, unless we see turnaround in these, particularly FI selling, if it stops and you start getting some inflows, and also FDIs. Now, the budget has proposed to support the data center setup in India with a huge tax holiday. Whether those things turn into actual inflow, these are the things that we will see. So until these things are seen changing, I think the rupee's relief rally should halt somewhere near about 90. Technically, there is a very good trend line support that comes for the dollar rupee just under 90. I don't think a market will be selling big at these levels unless there is some compulsion because of some time bound inflows. Otherwise, I think even if they do sell, I expect the nationalized banks to absorb these flows. Let's also keep in mind that RBI may be looking to rebuild their reserves. Although their headline reserves look at 710 billion, they have a forward liability of over 75 billion as estimated by us, which they would like to replenish by buying the dollars when it dips. So I think the rupee rally is almost like, for this wave, it might be done. And we could be looking at importer cover for at least near term whenever there is a dip near 90. And exporters may well wait for, recovery towards 91 at least to hedge more. That said, of course, exporters have been under hedging themselves for quite some time. Therefore, do not expect USD INR to rally away to new highs in the near future. There will be selling interest at higher levels. And so I think we are more likely to see a two-way market, unlike the previous few months when it was all one way up. And buying dips and as well as selling rallies will be the order of the day. Thank you.
Thank you, JK. And yes, I think the million-dollar question that everyone has been asking is whether this entire trade deal that has been announced is like that's the that's it for the rupee depreciation story. But unfortunately, a lot of things to be looked at. The fine print has still not been released. There is some a little bit of clarifications that's been released. For example, the $500 billion purchase which President Trump announced India will make. The Indian side has clarified that it's over a period of 5 years. But of course, a lot many fine print will be looked at. Indian side is very clear that the agricultural interest has been taken care of. So that is not a bit of a worry. It's also becoming clearer that the penal 25% tariff, which was imposed on account of Russian oil purchase, that has also been removed. So that's becoming clearer. So overall, I think now the tariff rate is down from 50% to 18% overall. But what products will get what tariffs, that's also something to be looked at. In the end, for USD INR, I think that's what we have been repeating on this podcast for many, many years, I think, is it's always dependent on flows. So how the flows, how trade and balance of payment deficit plans out, it will drive USD INR. As of now, looks like there's a good support for USD INR near rupees 90. RBI may be looking to build their own reserves and get out of some of the short dollar forward positions that they have built. So that's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.